ETF, in the full words, called exchange traded fund. So it is a basket of securities that tracks an underlying index. You may track a Hong Kong Hang Seng Index, Singapore Straits Times Index, and US S&P 500 Index. Okay, so basically, by investing in this investment, it provides you access, to a portfolio of stocks, bonds, or other asset classes. There are so many ETF nowadays in this world. There are more than 6,000. As you can see here, these are the description of a different form of ETF. Okay, and these are the provider of the ETF, and they also show here very clearly of what kind of the expenses ratio for ETF. If you look at ETF here, I want to actually emphasize here very importantly is that some people get confused. No, I still don't understand what is ETF. So basically, what you can do is that you can consider ETF, okay, as a cross between unit trust fund and stocks. Okay, so it is very diversified, just like a unit trust fund, but at the same time, it is tradable, like stocks in the share market. Most of the ETF are passively managed because it's supposed to just replicate the performance of an index. It will track index like maybe a market in China, in Hong Kong, in Singapore, in Europe, okay, or a specific sector. It could be a technology sector, it could be a banking sector, it could be also a semiconductor sector. One of the most famous is the S&P 500 index. Okay, of course, it's famous because Warren Buffett always use it as an example. So later I'm going to talk about it more. Okay, so if you look at the example here that I mentioned, there are so many ETF, so many choices, and to invest, you better understand ETF better so that you can make a better choice. Other than the traditional ETF, there are also other category of ETF. For example, smart beta ETF. Okay, so smart beta ETF basically use a system to select certain stock from a particular index. So which means to say, compared to traditional ETF that track all the stocks in the index, this smart beta ETF try to select using certain criteria, maybe growth factors, earning factors, or dividend factors, in order for the ETF to perform better. There's also another what we call leverage ETF. So leverage ETF intend to amplify, multiply by 2, multiply by 3 the daily return of the underlying index. And there is also inverse ETF, meaning opposite. It aims to deliver a daily return based on the opposite performance or the inverse performance of its underlying index. You can see from the chart here, this is a normal index, this is a leverage index, this is the inverse index. We know that now ETF is getting more and more popular, but how popular it is, okay? So let me share with you some picture. One is if we look at the asset under management of ETF in US. Next, we're looking at the asset under management in the world. So you can see for the past 10 years, from 2011 to 2020, passive wealth management, which means ETF, has been growing at 375%, whereby active fund management is growing at 99%. If you look at the world market, it's almost the same, the growth rate. But if you look at the market share, we can see that active fund management still have a bigger share compared to ETF. And if you look at the world, then active fund management have got about 72% compared to passive management of ETF, 28%. So basically, yes, ETF is growing very fast, but active management still dominate the market.
If money is important to you, please remember to subscribe to my channel.